Can you believe you're on chapter 49? Well done by you. You've been very persistent, and we hope you've been learning a lot during this course. For our chapter 49 instructional video, I want to introduce you to sort of an advanced topic, and that is the difference between how the federal tax system handles Section 179 expensing versus how the California income tax system handles that idea of expensing rather than depreciating a business asset. So we talk about this in your textbook, but we want to give you an example of how it works in real life. So I've set up the test account to have business income from babysitting. He's got a very successful babysitting business now. And total income from that business was $200,000 during the year. Okay, so did really well for the year. And what you'll find when you're dealing with people who have business income is that they want to reinvest in their business to be able to increase this gross income number. So in the case of our test account with the successful babysitting business, let's say that this taxpayer, in order to increase his business income from the babysitting, purchased an extremely expensive swing set. Okay, now he put in $150,000. You can see over here, bought this swing set for $150,000, and the swing set is specifically for business, so it's a business asset. Whenever you see the purchase of a business asset, you got to think automatically, okay, depreciation. I'm going to need to take that deduction over a number of years. And so we've set up the depreciation screen here for this extremely expensive great swing set. We pointed the depreciation deduction to the correct form because it's related to business income on Schedule C. We made a little note, it's for babysitting. The category is machinery and equipment. Date, place, and service right at the beginning of 2010. And here is the cost basis. So that's how much the swing set cost. Now, once you have the basis here, this Section 179 of the IRS code is a way to essentially expense the entire amount of the business asset as opposed to depreciating it and needing to take the deduction over the life of, or over the useful life of the asset. Okay, so with depreciation, remember, you're taking that deduction in pieces. In the case of business machinery, the common recovery period is 5 years. So you would take this deduction, $150,000, over the course of 5 years. However, under Section 179, what you're allowed to do by the IRS code is increase the amount that you take in that first year. So that's the difference between expensing versus amortizing or depreciating. Depreciation, you take the deduction over the course of the useful life, whereas expensing, which is done under Section 179, you can write off the entire amount, you can deduct the entire amount of the purchase in that first year. And this is very valuable for a lot of business owners because many accountants are all about deferring income tax. So you'd rather have a deduction now a lot of times, especially if you had a good year. You know, this taxpayer made $200,000, so they may want this entire deduction. And Section 179 allows them to take the entire deduction in that current year. Okay, we still set up the depreciation as 5-year property under makers, just to show you the difference between how federal handles Section 179 and how the state. But generally speaking, this Section 179 allowing businesses to expense more in that first year whenever they purchase business assets is one of the favorite tricks of the federal government to try to increase business spending, so business investment. However, California does not always conform to the federal rules on Section 179, and we're going to see that right now. So let's take a look at the actual forms here. So now we're on the Schedule C for this babysitting business here, and remember the Schedule C obviously is a federal tax form, and we can see here that the income, $200,000 total income from this business. And then we have down here a Section 179 depreciation deduction, current year depreciation deduction of $150,000. We can see on the tax summary how this translates out. So we had $200,000 of business income, and we have $150,000 Section 179 deduction, leaving us with $50,000 of business profit. Now, I want to contrast that with the California tax return, which has a lower amount of Section 179 expensing that's allowed, and the California allows only a maximum of $25,000 as opposed to the federal, which allows up to $500,000. Okay, so big difference. If you buy that $150,000 swing set, you're going to be able to Section 179 the entire amount of that on the federal, so take the whole deduction this year. However, when we go over to the California tax return, tax summary, we're going to see that $100,000 of that deduction was added back in to the California income. So effectively, this deduction, $100,000 of that $150,000, is not being allowed by California. It's being adjusted. So California has a different rule about how much you can expense of that business purchase than the federal. Federal is much more generous on that point. And let's look at the actual 540, California Form 540, to see how this works in practice. Okay, so we can see here that the federal adjusted gross income is $46,467, which is based again on the federal AGI. So that's kind of the starting point of the California tax return, and you can see this California adjustments addition, $100,000 is being added back in to the California income to arrive at the California adjusted gross income. So again, it's not allowing that entire Section 179 expense.